some of this stuff. So I'm going to start with a very cool picture, which is called a volatility surface. And the volatility surface is basically what you look at when you're trying to figure out what the price of an option is. This is the volatility is basically the only input in an option that determines market price. So if but literally everything else is a market standard. The only input that determines what the option premium difference is the volatility. That's why the volatility surface is really the main source of pricing or of difference in market opinion on option markets. So what I wanted to show you here is the volatility surface September the 28th. Can anyone tell me why there's this sort of, it's lower here and then it bumps it? And before you answer that, I'm going to explain what we can see. So on the bottom here, on this axis that you can see, can you guys see my mouse?
Yes.
Okay, that's the strike price. Here is the value of the volatility in percentages. So that would be 20%, that's 35%, that's 10%. This is the SPY, so this is the ETF on the S&P 500. So this is basically the value of the number of that ETF. And then this is the expiry date. So essentially here you've got the strike price along this axis, you've got the overall value of the volatility, and then you've got expiry dates that go like that. Can anybody venture a guess of why there's this sort of flat period of low volatility, then it bumps up right on the expiry around, call it November 2020, and then it trails off a little bit more? What happened around November 2020?
Oh, there was a spike in the market, I think, wasn't there? Well, market went up.
No, it's the presidential election.
Oh yeah.
Right. So volatility is often driven by uncertainty. So the more uncertainty, the more there's the potential rise in volatility. And so that's why you see this cliff here on volatility, is because here was the presidential election and there was a lot of uncertainty around what was going to happen and what the policies were going to be implemented. So insuring against a drop is more expensive when you have that uncertainty. So often options are considered as an insurance, and the more uncertainty there is, the higher the price of that volatility, and therefore the higher the price of that insurance. Any questions so far? Okay. So if you look at the volatility slightly, so that was on September 28th of 2020. That's the date that we were looking at it. See, this is the 20th of September here, which is basically the date at which you're starting, and these are the expiry dates. And if you were to look at it essentially about a month earlier, the volatility looked very different. And this is usually more the way that a volatility curve looks, is that it's slowly decreasing. You had a little bit of a spike here for the presidential election, but you didn't nearly have as much. And you had a little bit of a bump here on the near term because of the market correction that was happening at that point. It wasn't a big correction. It was just basically trading within the range. I don't think I mentioned it, but I'll mention it on a future graph. This is what an option tables look like. And this is Interactive Brokers. I don't know what broker you have, so it's going to look different everywhere. But I was going to try to explain this so you guys can get a sense of the way options work. And I'll do that a little bit later, but I just wanted to show you what the table looks like. So oftentimes you're going to have a strike here. You're going to have the strike price here, which is basically, this is SPY. So I'm just using the S&P 500 as a proxy. You're going to have, depending on how your platform works, these things are going to be very different. But on the left side here, you've got the calls here. On the right side, you have the puts. And then this dividing factor in the middle is basically the difference between in the money or out of the money. So is anyone familiar between in the money and out of the money options?
Yes.
Do you mind, Barry, can you sort of give us the way you would explain it?
Okay. An out of the money put would be a strike price that would be well below what the current market value of the stock is. And you would have a probability of finishing out of the money based on how far and the volatility of the particular stock would determine that price that the contract sells for that's out of the money. With a call, it's the same thing. It's out of the money that's way above the stock price, the current stock price. And again, you're looking at the implied volatility and the date all determines the price of that options contract.
Yeah, that's it. That's right. So I'll just rephrase that and then sort of say it another way. So there's two types of options. There's calls and puts. A call is basically the right to buy the shares. So if you've got if you were to buy one call on this screen, you would have 100 shares. You would basically have 100 call options because they sell these things trade in increments of 100 on shares. So just bear that in mind. So one option here trades actually 100 options. So you have the ability to buy at a certain price. And let's take the example of 350 here. If I were to buy this call option, which the ask here, if you look, this is the ask column. That's the strike price 350. So it's basically $9 per option contract, which is equivalent to 100 shares. So I have the ability at $9 to buy 100 shares at $350 per share. I also look here, up here you've got the expiry date. So the expiry date of this one in this case, so we were on essentially on the 20th of September, and it was November 2020 was the expiry date. So there's 37 days to expiration. So this one is considered an out of the money option because currently the price of SPY is around 347, and the price of the strike price of the option on the call is 350. So it's above the current price of the market. So it's an out of the money. On the put, you inverse that. So if I were to take this 350 strike price and look at the puts, these are in the money puts because the put is the right to sell at a certain value. So I have the right to sell the shares at $350, and currently the price is at 347. So there's already, it's because it's already below what the value can sell at. It's in the money. Is that clear to everyone? I don't know how fluent people are on option pricing or on option theory. So if you have any questions, please shout out. So this is a good way of looking at, there's multiple things that you have to take into account when you're deciding to buy an option, and these enter into the price of that option. So the first one, as we saw, is where's the strike price, and more importantly, where's the strike price function of where the current market price is. So you can buy a number of strike prices. Then the second thing that determines price of the option is the time to expiry. So if you've got longer dated options, and while I'm at it, let me bring up more recent. So I've got my interactive brokers open here. So I'll show you a more recent view of options, just so that it's an update. Can everyone see that?
Yep.
Okay. So this is updates as of close today, and this is on SPY as well. So the S&P 500 contracts. So, and again, you might have a different platform, so don't take this as gospel. But right now, the S&P 500 is around, call it 409, 410 on well, it's around 4,098, and on SPY that's about 409 because you sort of shave off the last digit. You've got weeklies and you've got monthlies on options. So in this case, you've got weeklies, and the expiry date for the weekly is tomorrow, and you've got one every week. Then you have monthlies, which are a lot more liquid. And you see here, I've got an option to take the weeklies and the quarterlies or not. Typically, the monthlies are going to be more liquid than the weeklies, and the liquidity of most option decreases as you go further and further into the future, with certain caveats. So January, which is called the leap option, is always going to be more liquid, for example, than the December contract. People tend to want to transact on the January of the next year. So January 2022 is going to be more liquid than the December 2020 option expiry. So here I only have the monthly options. So the next monthly option is on April the 16th. It's 8 days away. You've got one at 43 days away, 71 days away, 99 days away. And what I was talking to you about was the leap option, which is the January 21, 2020. So it would expire on the 21st of January, 2022, is 288 days away. What's important to look when you're looking at these options, so is the expiry, of course, because that comes into the price. The more expiry you have, the more the option is valuable. So that leap option, as you can see, if I take an at the money, it's about, the last transaction was about $23.25. And if I'm going back to the April 16th, the value was about $227. And that makes a lot of sense because the price has a lot more. It has a much wider range that's possible, and the option is to basically buy half of that distribution if you think about it. So the distribution of stock from now into the future is going to be a lot wider than from now until January 2022 is going to be a lot wider than the distribution from now until April the 16th. There's a lot more possibilities, and it's spread a lot wider. Therefore, if you chop off half of that, there's more of that's going to be valued. Also, bear in mind that options on equities always factor into the fact that equities go up. So they assume there's some sort of positive return over the long term. Does that make sense? Okay. So going into the price, strike price, expiry, not viewed on this is interest rates. Interest rates go on it because an option is a prepayment, because you pay up front the option and you only get the benefit later on, sometimes much later on. So right now that doesn't really matter because interest rates are so low that it really doesn't have a big effect on option pricing, but there's a financing component just to bear in mind. And then the important piece is the volatility. So the volatility component, and the way people talk about volatility is implied volatility. And this is what this is called here. See, implied vol is here. And bear in mind, there's two types of volatility. There's the implied volatility, which is what the option is pricing. And you can see it's different at every strike price because it essentially amounts to what you would back out from your option pricer. And there's realized volatility, which is what the volatility that you can measure on historical returns of the S&P 500 in this case. Now, if that was said too quickly, please jump in if you're not understanding, because I don't want to lose anyone. Okay, I'll assume that if no one's talking. Oh, I've got a question.
So you look at the implied volatility as like I do weeklies. So I look at a stock with a little bit higher implied volatility, and that will have less of a spread between the bid and ask for the contract, as opposed to a stock with low implied volatility seems like it has a bigger spread between the bid and ask.
No, so the level of implied volatility doesn't usually have an impact on the liquidity of the option.
Okay.
What has an impact on the liquidity of the option is whether it's a weekly or monthly. Monthlies will have generally speaking be more liquid than weeklies, and the further dated you are, whether it's a weekly or monthly, will be less liquid, with the caveat that like yearly ones at January are going to be more liquid than the December ones. But the easy way to look at that is just look at the volume that's traded on today. So the volume, this is the volume. So that basically just tells you how many options traded today. And then the open interest is also a good indication, because that's basically what amount of trades are open. So when you transact on an option, it's not like buying a share. There's not a certain amount of shares outstanding. When you buy an option, someone else has to sell an option. So that creates an open interest. That means that there's one contract that's open. And that's what this is recording. It's saying that there's been 3,064 transactions on the 410 strike price of the SPY. So there's 3,640 people times 2, 3,640 times 2 people that have made a bet on it. And half of them have made a bet that they want to go long, and half of them have made a bet they want to go short that option. Does that make sense, Barry?
Why are you doing 2? Is it because
there's on each side of a transaction, you need 2 people. You need one buyer and one seller.
Got it. Okay.
So this is just the open options or the open interest counts just the transaction. But it means that every transaction there's 2 people, right?
Got it. Okay.
The implied volatility, as you can see, changes with the strike price, and that's just because implied volatility is the only thing that's not fixed. Everything else, everyone agrees upon, essentially, in the market. So the interest rates people agree upon, it's the 3-month LIBOR, generally speaking, and that's banks that usually determine it. The strike price, everyone's agreed upon. The expiry date, everyone's agreed upon. The only thing that people haven't agreed upon, and that's why it's the pricing mechanism, is what the volatility is. And the reason you have what they call the option smile is that basically as you go to the wings, the implied volatility goes higher than when you go to the other side, is what they call volatility smile. And a lot of people put that on the 1987 crash. So when I first started at Morgan Stanley, I had some training on this, and one of the guys said before 1987 there was no option, there's no volatility smile, and since 1987, because everyone freaks out if markets crash, there's a volatility.
Ya, tranquila.
Sorry. Okay, so that's a little bit of the practicalities of it, and I'll come back to this, but I just wanted you to get a sense to put it into context. Now I'm going to go back a little bit into the theory, and then I'll come back again to the practical aspect. So that's what you saw on that page. You saw calls and puts, and you can go either long a call or short a call, and you could go long a put or short a put. This is what people call, these four graphs are payoffs or option payoffs. So when you're buying an option, you're buying the right. When you're going long a call option, you're buying a call option. You're buying the right to buy shares at a certain price, which they call the strike price, or X or K is often used as a symbol. So that means once you've hit that strike price, and we saw here in this case 348. If you're at the money, you start having your option starts having intrinsic value, what they call basically value based upon the fact that it's in the money. You can today exercise your option and make that money, right? Because if the share prices are at 350, you can today buy that. If you bought an option that has a 347 strike price and SPY is at 350 today, you can now exercise your option, buy those shares at 347, and then sell them at 350 in the market. Okay, so that's what this profit graph is saying. Is basically every increase in $1 of the underlying SPY is essentially worth $1 of profit. The reason you have a break even is you have to pay for the option premium. So you only break even once you've made enough money from the increase in price based on what the original option price was. And this is also called a terminal payout. And I'll get to what there's things before non-terminal payout. So this is basically at expiry what everything looks like. Okay. So just think about it, and there's a quick memorizing way of doing this. So let me just, which is much easier. I'll do it by drawing. Which, how can I draw here? Where's the drawing tools?
Click insert. There you go.
Insert. Where's the drawing?
Shapes.
Shapes. There we go. So if I take a white piece of paper, I put two lines here. And I put another line there. Okay. And I call this long and short. And then call and put. What essentially you do is you do this. And sorry if my drawing skills aren't up to par, but you draw something like that. So you do basically two shapes like that. And this is just a memorizing technique that they actually group, rotate up. There we go. So this is basically the term. It's an easy way of memorizing it. So draw two saucers, one on top, one upside down. Draw a cross in the middle of those two saucers, and basically now you have the payout structure of long calls, short calls, long puts, short puts. Can you guys help me determine which one's which? What is this one? So this would be long put. This one would then be, if that one's a long put, then you go below.
That would be, is that the short put?
Exactly, short put. So if this is the put, what's the other side? That would be long call. And if this is short put, then this would have to be
short call.
Short call. So if you don't have the papers, this is a quick way of getting out the structures. And I'll show you another memorization technique later on, or a way of thinking about things that's helpful to understand options. So if you think about it, this is the put side, this is the call side, this is the long side up here, and then the short side is on the bottom. So on the top you've got long, on the bottom you've got short. On the left, you've got put. On the right, you've got call. That makes sense because you go from left to right, you increase in price, and you're positive on top and you're negative on the bottom. So you're long on the top and you're short on the bottom. So if you have a hard time remembering the payoff structures, two saucers, one straight up, one upside down, and you put across the middle. And that basically, it's basically the same thing here. It's just that these are not in the same order. So when you're short a call, so in this case, short a call here, same thing as this thing here, you basically have you sold someone else the option to buy it at a lower price. So the only way you make money is if the thing doesn't move or if it basically goes down. So this is the underlying price. So if the price goes down, you keep your option price because it expires worthless. But if the underlying price here goes up, your profit loss, you start losing money as the increase in price of the underlying or of the S&P 500 goes higher than what you sold the option for. Okay, so just if you don't remember anything else, just remember when you sell options and especially calls, your risk is unlimited. So it's an extremely risky situation to be selling calls. When you buy a call or a put, your risk is limited to the option premium that you bought at. If you sell a put, your risk is limited to the strike price that you sold at versus zero, right? Because stocks don't go below zero, which is not true in commodities. Commodities can go negative. And it's already happened as well in interest rates, that interest rates have sometimes gone negative. Just bear that in mind. Selling a call, and I'm talking about a naked without any other qualifying. Selling a call has unlimited risk to it. So
that's a reason why I think you can't do that in a IRA account.
That's possible. I'm not familiar with the IRA, but I haven't traded options in the IRA. I've only traded options in sort of normal accounts. So the Greeks. Is anyone familiar with what the Greeks mean, or not?
Yeah.
No, Jorge. I'm seeing no.
No.
Bill,
Yeah.
no. Okay.
Yeah.
So the Greeks are basically we call them Greeks because in math you use Greek letters to identify derivatives. So the derivative of something. So I don't know how well your math is, but basically a derivative is what the value of y changes for a small change in x. That's essentially what a derivative is. So in option world, that means what is the change of the value of the option premium, so the value of that option, versus a change in the S&P 500. So the underlying stock price, which in this case we're talking about is the S&P 500. So that's what the derivative is how much does the value of your option change for a dollar movement in the S&P 500. Because we're looking at SPY. And another way of looking at it, that delta, is it's equivalent to the amount of shares that you're long if you buy a call of the S&P 500. So if you wanted, if at a given point in time, let's say you buy an option that's at the money, your delta for an at the money option is 50%. So if you bought one option contract, which represents 100 essentially 100 options that you can buy at the money price, that means it's equivalent to 50 shares. Does that make sense? An at the money option is basically a 50% delta or 0.5 delta. And there's two ways of looking at it. Is that means for a $1 increase in the S&P 500 or SPY, you've got a 50-cent increase in the option. And that's equivalent to being long 50 shares. Okay. The gamma is what we call the second derivative. And the reason there's a second derivative is if you look at options, this is the payoff structure typically. This is what the blue line, the non-dotted blue line here would be what the value of the option is before expiry. So when the option hits expiry, it's worth this. Before it hits expiry, it would be along this blue line. It has time value. That's what we call time value. The time value is basically the piece that's between this blue line and the dotted line. Then the piece that's between this dotted line and zero is called intrinsic value. So this is basically the in the money options. This is the out of the money options. So in the money options have intrinsic value. Out of the money options have no intrinsic value and only time value. In the money options have intrinsic value plus time value. So before expiry, that's what the value of your option looks like. Because this is not a straight line, that means that the derivative doesn't just have, it has more than, there's the second derivative of this line is not zero. And so given that it's not zero, that's what they call gamma, where it's essentially the additional fudge that you need to get from your delta to your actual change in price because there's a slight more convexity. The first derivative would represent this whole thing by a line. So if I were to represent the delta here, it's this, and here is, these are different time lags. So the blue would be, you were a lot further away from expiry. The red line is you're closer to expiry. And then you see this delta line is basically just the tangent to that red line. And that's basically what the derivative is. Now the gamma is basically that difference if I go a little bit further up where there's a gap between that red line and the green line. So the gamma you're not going to use too much. The gamma is mostly important when you're close to expiry because it increases a lot. So the closer you get to expiry, the closer the gamma increases, the more the gamma increases. And so you get your delta can start moving a lot. And the reason that's important is because that means that the price of your option can swing quite a lot in percentage terms. So we covered the delta and we covered the gamma. Now there has to be some questions here, or else I'm not good at my job. Phil, you're on mute, I think. You're still on mute. We can't hear you. Barry, any thoughts? Jorge, any questions?
Now,
this is fairly new for me, so I'm trying to digest a lot of information.
Okay. So I'm going to the theory and then I'll go back to the practice because not all of this is necessary. So the same way I told you, there are three things you need to input, and sort of the delta and the price. The delta and the gamma are the ones that are relative to the price and the strike. The theta is relative to the time to expiry, and the vega is relative to the implied volatility. So the theta is basically the derivative of time. It's basically how many dollars per day if the S&P 500 doesn't move, do you lose on your option? That's what the theta is. And you can see it on this thing. You've got the theta here. So it's not like these are completely theoretical things. They're also quoted. But you've got the delta here. You can see on this graph. You've got the gamma here. You've got the vega here, and you've got the theta here. Most brokers will give you those numbers. So you don't have to calculate them. You just need to know what they are.
Daniel, on your table, like I trade on Thinkorswim, TD's platform, and
Sure.
they give you the probability of finishing out of the money.
Yes.
So the Greek thing is helpful. The probability of finishing out of the money is a little bit more understandable for us amateurs when we're doing that, because we can select a probability percentage. If you don't want to be called off or assigned, then you can figure the probability of being out of the money at the finish percentages in a column, and you can select that area that you want.
So I'll show you something along those lines a little bit later. But the thing is, I don't know how those things are calculated, so I'll show you a version of the way you can assess that.
Okay.
So just getting through that. So the theta is how much you lose, how many dollars you lose per day for each option, and the vega is the change in price for an increase in 1% of volatility. So essentially, what these are saying is that let's take this option at 347 strike price. That means for every dollar increase in SPY, you get a 53 cent increase in your option, and then you have to add another 1.6 cents for the gamma. So and this accounts for all of it. So the gamma is small here. If you have a 1% increase in the implied volatility, so if this goes from 23 to 24, you've got a 43.6 cent increase on the value of your option, and then each day you're losing 14 cents on your option. Okay, so the theta is often very important because you want to know what your burn is per day. and the theta tends to really increase when you're very close to expiry. So if I go back to my practical to my more recent things here, you're going to see that if I'm 4 days to expiry, my theta is going to be higher on my at the money here. See, I'm at 18 cents or 19 cents. If I go to my January one, and you've got to think about it in percentage terms, it's going to be 4 or 5 cents here, right? And on a percentage of what this thing is 24.3, I'm losing 4.6 cents. And on the other one, which is I'm losing 46 cents here because this is the weekly one. That's 1 day to expire. I'm losing 46 cents. So I'm almost losing half the value in 1 day, which makes sense, right? Because if it doesn't go above the strike price, then it's worthless. Okay, does that make sense?
Okay.
Yes.
So just bear in mind that the theta burn starts getting very high. So if you're selling options, you like theta being high because that way you're losing a lot, but it also probably means you're close to the strike price. And if you're trying to make a bet with options where you're not really where you're buying them, the theta is a negative for someone who buys it. It's positive for someone who sells it. It's negative for someone who buys it. Okay, so that was sort of going through the Greeks. Now the intuitive way of thinking about it, because I think it's helpful for when you're looking at the whole table to think about how to think about it intuitively. If you were to draw this payoff, so this is a long call, and you can do this with all the other ones that I mentioned here. You draw this thing, and then you basically try to draw a curved looking thing that touches the points on each tip, and then that gives you a lot of intuition on what happens. So as I get closer and closer to expiry, I go from the blue line to the red line to the dotted blue line. That's basically my theta, right? So my time value of money goes down. So as I get closer to expiry, my theta kills the value of my option. Okay, so it's as if I were to draw I would have drawn an arrow, and my theta is going in this. As I go closer and closer to expiry, this curve goes in that direction, and I'm losing time value during that time. Okay. What my Vega does is, for assuming these could be two, the red one now, taking out the red one, assume the red one and the blue one are at the same expiry. The blue line is the one that has a higher implied volatility than the red line for a same time step. And the reason being is typically the amount that the stock price can move from now until expiry is essentially the time to expiry times the amount of volatility that you have, right? If you have very little volatility but a lot of expiry, but and a very little time to expiry, it's not going to move much. If you've got huge volatility and a huge time to expiry, the possibilities of the price are very large. So this increases that value. So they basically work in concert. Okay, time goes up and volatility goes up. That means basically the price goes up. And then, like I said, that gamma is that little fudge thing. That's the difference between the delta and the gamma. Okay. I think that's mostly enough for the theoretical part, and this should give you an intuition. So if you're really thinking about it, it's easy to trace this on a piece of paper, think about what's happening to get a sense of what risks you're taking. So the typical thing that most people are going to want to do is probably the covered call. And the covered call is interesting because it generates income while not taking more risk or substantially more risk. But for it to be covered, there's a specific thing that you need, is that you need to hold the underlying stock. If you don't hold the underlying stock, then you're selling something naked and your liability is unlimited. So you're trading options, and you need to bear that in mind. Okay. So covered call means sell as many options as you have stock. So if I have 100 shares of SPY, which we've been taking as an example, I'm selling one option contract because one option contract's worth 100 shares per option contract. Okay, does that make sense? So the reason it's interesting is because what you're doing is you're going from, this is your long position, which is basically the position you have if you buy SPY. So let's say I bought 100 shares of SPY, I've got this position. So I bought it at this price. That's why that's the profit or loss. So if I bought it at 350, if it's above, I make money. If it's below, I lose money. So I bought SPY at 350. I take the strike price, call it at roughly 350 again. Here, 350. If it goes above 350, I start losing money, right? But because I've got the 350, I'm not really losing money. I'm just making the option premium. I'm not making any more on my shares. So that's what this looks like, right? It's the combination of that graph and that graph goes into that graph. So if I sold call options at 350, what I'm making is I'm not making any more money at 350 on the long position because I have the obligation to sell it to someone at that price if it goes higher. But I've made the option premium, which is that difference between that yellow line here or orange line and that blue dotted line. That's the whole principle of a covered call. It's basically making the option premium on a piece of the upside risk that you don't think is achievable, that you don't think the underline is going to go to. Does that, in theory, make sense? And then I'll get a little bit more into specifics. Barry, Phil, yeah.
Yeah,
thank you. That does make sense.
Okay.
So the pros of that is that you get extra income from selling the option. So you get that money. The con is that you give any upside beyond that option strike, right? So that's why it's called a covered call. This is the easiest way to generate income, especially if you, and it's also a way of risk mitigating if you think there's going to be a crash, right? Because if you think there's going to be a crash, you think this option is going to expire worthless, and you're probably going to lose money anyways on your underlying, but at least you're going to mitigate the loss of the S&P 500 going down because you're going to be making the option premium. On the flip side, if you're wrong, you're only going to be making the option premium, and you're not going to be making any upside on the stock, on the S&P 500. So that's sort of the idea behind the covered call. And this is a protective put is another one. So you've got the option of selling the option on the upside, and then you also have you can also do something else, which is buying an option on the downside, which is another. It doesn't hold much risk in that sense, because what you're trying to do is buy insurance if there's a crash in the market, right?
Right.
So if we say the SPY is at 350, and you're worried that you're going to lose too much money if it goes below 300, you buy protection or insurance that you can sell it at 300 if ever it goes below that. So you buy one option contract for your 100 shares at the 300 put strike price, and that's what this represents. So you're basically, and here it's GDX in this case, but you're buying a put option at the 45 strike. If it goes below 45, you start making money on your option contract, which is in black. You're long basically the GDX here. In this case, you would be long at 55, so you're buying it at 45, so $10 lower to protect yourself. And your overall payout structure is going to look like this. And so you're still going to lose money overall, because if it goes below, you paid the option price, but you're just not going to lose any more money beyond 45. You're going to be capped at something around $15 here. Does that make sense? So a protective put, you buy a put as an insurance in case the market crashes. Pro is you're less likely to lose money if there is a collapse. Con, you are paying the insurance, therefore you're actually, you're going to be losing money on that. It's a sunk cost, right? It's an insurance, so you're going to be losing money no matter what. You're going to be losing the option no matter what. Now, what you can do as well is, so a covered call is a way of generating income. Essentially, a put is a way of protecting yourself against a fall. You can also combine the two, and you can basically say, I'm going to sell something on the upside that's going to offset something on the downside. So I'm going to sell a covered call to generate income because I don't think it's going to go that high. And with that premium that I generated, I'm going to buy a put to protect myself on the downside. It's what people call zero cost collars. And you equate basically the amount that you're paid on the covered call with the amount that it costs to buy your put, so that it amounts to zero. And so what you're changing is you're selling some upside to protect yourself on the downside. Make sense?
Yeah.
Okay.
Yeah.
And again, there's different ways of using this. You can either use the covered call by itself, the protective put by itself, or you can use the two together. And you also have to bear in mind that there are ways of thinking about rolling it as well, because this is a dynamic strategy. Options are dynamic because they have an expiry. So if you're getting into this, you just have to bear in mind that it's not a buy and hold type of situation. It's a situation where you have to be looking at it, and if something expires, you have to maybe re-enter to start generating again. So this is coming from Bloomberg, but you can do the calculation yourself, and I'll show you on the Excel spreadsheet how to do it. There's different things that look like volatility. So you've got the SPY, which is it's the 50% delta volatility of the SPY. So it's basically your implied volatility at the 50%, so at the money, at the strike price, at the current price of the market. And so that's what's in white. And what you can see is that there are other things that follow this. So you've got the VIX index, which is the volatility index of the S&P 500, and that replicates it fairly closely, and it's the point of it. And the VIX is basically just the 1 month expiry option. And then people look at it, there are futures that trade on it. It's not very liquid though on the futures side, so I wouldn't look at it too much. On the flip side, you have what VXX, which is an ETF that uses the futures to replicate something. And the interesting quality of VXX is that it's been a loss-making ETF or ETN, actually, exchange traded note, since 2010. It's never made money. It's always lost money. And the reason being is that volatility, it's got a natural decay to it. So another thing, and I won't get too much into it, if you want to go short volatility, is to sell options on VXX, or just short VXX, which is basically that ETN, exchange traded note, which is similar to an ETF. The only difference between an ETF and an ETN is that an ETF holds shares, and an ETN uses futures to replicate the exposure that you're looking for. Okay, now I'm going to shift slightly, and I'm going to show you, not that one. That's not what I was looking for. This one. Okay, here we go. So what I've done here is I've taken the S&P 500 prices, and since 2000 and up until today, and then I'm going to try to figure out what makes sense, sort of, to where should I sell my covered call and where should I sell my or where should I buy my protected put. And there's two things you need to bear in mind when you're doing this. You need to bear in mind, what is the percentage change that you think that the S&P 500 can change, and how much time do you give it to change? So you've got to combine that with what it's essentially what you're answering. What expiry do I want to sell the covered call at, and how far out of the money do I want to sell it? Those are the two. So what strike price and how far dated is it? Because the other stuff you don't really have that much impact on. You can put a limit price, which will determine if you get a little bit of fill on the implied volatility, but there's really a market price for volatility, so you're just waiting for the implied volatility to come to you. So if you're transacting that market, the only two decisions you have to make on selling a covered call is the amount, how far away from the current value of the S&P 500 you're selling, and then how much time do you give it to reach that goal. Of course, the further away the higher the strike price you sell it from where the current market is, the lower the value of the option, so the less money you're making, and the further dated option you sell, the more money you will be making on that option sell. Okay. Now, what I did here is that if you want to sort of get a sense of it, what you can do is you can calculate what the returns of are historically. So what I did here is I just did I took the return of the S&P 500 over a period, in this case, of a rolling 60 working days, so about 3 months, because there's about 21 to 22 trading days per month, because you don't count weekends. So if you only have trading days here, because those are the only prices on trading days, that means about 60 days is about 3 months. More accurately, it should be probably something like 63, 64, but 60 for the round number. And what you calculate, all you do to calculate the return is you take what the price is at now, you divide it by the price that it was when at the beginning of those 60 days, and then you subtract 1. It gives you a percent. It basically says since the 3rd of January 2000 to the 28th of March 2000, there was about a 3.8% increase in the S&P 500. Okay, and I'm going to do that for all the numbers until 2021, until today. Then what I can do is I can build essentially a distribution to see, on average, what happens to the S&P 500 when I look at it historically. What's its distribution? And in this case, I sort of cut off the distribution, so I counted for each bucket. So here you've got the bins from 20% to above 20%, and then I counted the amount of times it was within those buckets. So from minus 20% to minus 18% over that 60 days, minus 18 to minus 16, and so on and so forth. Okay, and in this case, I restricted what I was counting, and you can do a bunch of analysis on here to see what you're comfortable with, but I restricted it to the post-financial crisis by starting in 2010. Okay, so I only took into account the returns after the GFC. So what you see here on the distribution, if you just take that into account, and that's not necessarily the right way of doing about it, but you can try a number of things depending on what market environment you think we're in. It basically says on average over a 60-day period, the S&P 500 goes up about 5% since 2010. You see that there's this drop off. It's got this fat tail on the left side, which is bigger than the fat tail on the right side, and that typically it's got little probability of going above 12 to 13%. So if I were to measure, these are the actual numbers here. So above 14% happens about 4% of the time on 3 months. Okay. Now I could change this analysis by saying I don't want to do 3 months, but I want to do 1 month. So instead of taking 60 days, I'm going to take something like 20 days, right? So what I would do is I would go back here. I would take 20, so that means it's there. So that number would be there. Is that 20 days? Did I do that right? Yeah, that's 20 days. And then I recalculate that, and then this updates. And so this distribution looks different now if I just look at 20 days, okay? So if I look at 20 days, it says on average, maybe it's more around the 2-3%. That's on average that it goes up. The cliff here looks more around the 8% level, not really around the 12-13% level. And I still have a little bit of fat tails, but it's a lot more even. So that can also be a way of thinking about it, what you want to determine where you want to sell it, you know? If you rather take that risk over 1 month or 3 months, it might be determined by the distribution that you believe is the most accurate of the current market environment. Okay. Now, why do we look at these percentages? Because the reason, so let's say we're looking at the 1 month expiry. This is the 20-day expiry, and it's trading days again. And when you're going to see this on the platform, like Interactive Brokers, if I recall correctly, these aren't, and you have to check on your individual platforms, but the days that they quote here are not trading days, they're calendar days. I recall. Makes sense. You have to check it, but you have to check what these days to expiry are, if they're calendar or trading, because the volatility is not going to be the same if you're considering trading or calendar or trading days. So what I would probably want to do here is, depending on how comfortable with I'm the risk, I want to probably sell something at either 8% above the current strike price or 10%, and I'm going to take that bet because I believe that, let's say if I sell 8%, there's only a 5% chance that it happens. And I don't think the S&P 500, it's trended like 80% since the beginning of since March of last year. So it's up really a lot. So I think it's unlikely it's going to skyrocket maybe another 20% in the next, another sort of, in this case, 8% in the next month. So I think I would feel comfortable with selling a covered call at around 8% above the strike price. So 8% above the current strike price. We know that the current price of the S&P 500. So we look where the S&P 500 is. So the S&P 500 is at 410, call it. Now 410 times 8%. And plus, so it's 1 plus 8 times 410. That means I don't think the S&P 500 go above 442.8. So let's call it 443 to have a round number because you can't trade decimals. So 443, I don't have that. So I have to choose between 440 and 445. This is the weekly, so I'm going to go to the monthly. That's 8 days, so I don't like that too much. I'm probably going to then pick the monthly that's a little bit more liquid, and that's closer to what I'm looking for. This is 43 days. So iteratively, I'll probably have to go back and see what 40 days looks like to get a better sense of it and then come back. But in this case, let's just take this for granted that this is basically about 1 month. So I'm said that 442.8, so 443. So I would have to get comfortable between 440, 445. I think I'd probably be comfortable with 440. So what I would go do then is I would sell as much, I would sell at 36 cents as much exposure to the S&P 500 I have. Has everyone followed me so far or not?
Yeah.
A little bit rocky, but pretty good. Pretty good.
Okay. Please throw the questions. Please throw in the questions.
Well, I'm really curious into knowing, how to make these decisions, and I think you're going over it. It just seems slightly overwhelming since I don't do options.
Sure. And there's a lot to learn in.
Right.
there's a question, why don't you use a delta as a probability? Delta is the equivalent of a probability. Most of the time, it's not exactly that, but it's basically that. I don't think I'm not sure how you would use it. There's another question about selling puts in a rising market. If you sell puts, just bear in mind that you're just increasing your exposure to going long. Selling a put is the same thing as going long more of the S&P 500. It's exactly the same thing. So you're not reducing risk, you're just increasing risk. You're just putting on another type of risk in there by basically going short the implied volatility. You're just thinking that you're making a bet that the market won't crash and that volatility will probably be tame. So essentially, you're making a bet on the market won't crash, but it's the same thing as just going long a little bit more. So this is the decision-making process, and you can find this history in Yahoo, for example.
Post. Bryson DeChambeau doesn't know what else to say after Rob Masters star.
Sorry, that's my blooper. Sorry about that. So you can find this on Yahoo. Yahoo Finance holds these things. You can download them. I took the example of the SPY or the S&P 500. You can use this on most stocks. What I would say to anyone is that if you're going to sell an option, sell it on a liquid option. Sell it on stuff that's liquid, because on stuff that is illiquid, it's a lot harder to know what the price should be, and you'll have a wide bid-ask spread. So you might sell something that's not very valuable. So I'll go back to this slide. How to choose which options to trade. Do your homework. Look at the distribution over time horizon. So that's what we just went through on that Excel spreadsheet. Look at the distributions. Get comfortable with those. Make sure you're trading a liquid market. So Apple's going to be liquid. Amazon's going to be liquid. The S&P SPY is going to be liquid. If you buy like a penny stock, that's not going to work, right? The corollary to that is you do have the possibility that if you're trying to hedge on the portfolio level, you can sell an index to manage your overall portfolio. And there's multiple ways of thinking about that. But let's say you mainly buy my big caps and you've got $200,000 of exposure. Well, you're going to look at the S&P SPY as a sort of a macro hedge to that whole thing, and you're going to sell an equivalent amount of dollars in SPY. Okay, so let's say you've got $200,000 of S&P 500 stocks, but they're not exactly the S&P 500. You might sell SPY options to cover that amount of stocks. But bear in mind, you have to sell it. It has to be the strike price times the number of. You basically have to look at what your strike price on the SPY is and multiply it by the value of that SPY, not just the option premium, and that has to equal to 200,000. So the calculation you do is that if I have $200,000 of exposure to big cap stocks, I divide that by the strike price, and then that gives me a number that I didn't divide by 100, and that gives me the number of option contracts I should sell. Does that make sense?
Yeah.
No. And there's a basis that's still a covered call, but there's a basis risk because you're selling something that's the SPY, and you've got other stuff that's not necessarily the SPY. But it might be easier in your portfolio to do that because you don't want to be trying to sell Amazon, Apple, Facebook, Microsoft all independently, which might be a little bit more tedious and cumbersome. It also might be less valuable because individual stock tends to move more than a basket of stocks. But just bear in mind it's an option if you don't want to get tripped up into too much complication. So look for liquid options and strikes to reduce your transaction costs and to avoid basically getting transacted. Never leave an overnight price on an option because the market could have moved. This is something you have to do that's during market hours, preferably before 4:30 Eastern time, because generally liquidity decreases after 4:30. The maximum liquidity you're going to have on options is going to be between 4 and 4:30 Eastern time. Sorry. 3 and 3:30 Eastern time. 4 is the market close, so I'm thinking my London hours, which are separate. 3 and 3:30 Eastern time is basically when the liquidity goes down. Between 3 and 3:30, between 3:30 and 4 is when the liquidity goes down. Between 3 and 3:30 is when you've got optimal liquidity. Look at the delta to get a sense of what share exposure you are getting, because that also gives you an idea. If you're selling a covered call, it'll tell you basically how much you're reducing your exposure to the number of shares. So if I'm selling an out-of-the-money option, which you're probably going to be doing if you're selling covered calls because it's going to be above what the current strike price is, you'll probably have maybe 20% of the equivalent. So if you were long 100 shares, you're only reducing your exposure to about 20 to about 80 shares, because it's like you're subtracting 20 shares. If you're selling a 20% delta, so a 20 stock that's slightly out of the money.
Hey, Daniel, would you you said that was 330 to what, 4?
So optimally, you want to probably do your trades around between 3 and 330. I'd say 3 to 4 is probably okay, but the liquidity drops the closer you get to 4, and it's not that liquid in the morning. And you don't want to be picked off by like a market maker, because options is not always a liquid market, and the banks are basically just, this is how they make a lot of money doing this, and they typically tend to sell. So it's not a nice person's market, the option market. It's not sort of a gentleman's market.
I have found a little bit of increased action around 10 o'clock Eastern Standard Time.
That's highly possible. I'd say the still liquidity is going to be around 3. It's going to be post 3 o'clock and
Right.
before 4 Eastern.
Yeah, I don't know what happens after 10 o'clock in the morning, but something takes place that starts to speed up the trades.
Asia might wake up. Who knows? If you're selling covered calls, think of the strike, and not necessarily standard deviations. Another way of a percentage, the amount of percent away from your current strike price. So when you saw that distribution, you're thinking about it in how far away you want in percentage terms relative to where you currently are. So you look at historicals to give you a sense. And you can look at different market environments. So if you were to look at the .com bust, or you look at the global financial crisis, that would give you a different distribution than if you were looking at the past 10 years. So you have to bear that in mind when you're making your decision of where you want to sell, what strike price you want to sell. Never sell more than the amount of shares for a covered call that you have. That's for a covered call. Again, if you're going naked, it's a separate question, but again, unlimited liability. You can use a liquid proxy if your stock does not have liquid options, but that adds a basis risk to what you're doing. So selling essentially the SPY against a basket of the FANG stocks, for example. Callers can be effective at selling upside potential to protect downside risk. So that's the idea of selling your covered call and buying a protective put to reduce your overall risk exposure. So basically selling some upside to protect yourself on the downside. So the best so just bear in mind, the best outcome of a zero cost collar, or selling a covered call and buying a protective put, is that it expires worthless. In the case that it drops, generally speaking, you'll lose money on the shares that you were long. Even if the protective put gives you money, it only limit your losses. It won't provide you additional income. So it's a loss limiting mechanism. It never provides you additional value, essentially. It's a hedge. It's not. It doesn't make you more money, and it doesn't but it reduces risk. Okay, and so this, I've included a reading list, which I'll post in the chat, and it'll be available on the recording. These are just a few resources that you can take a look at if you're interested in diving a little bit deeper on options. That's all for today. I thought it was going to take a lot less time. I hope that was helpful. If you have any questions, please shoot away. So, okay, I see a few questions here. Why don't you use probability that I answer? I use spreads with $5 wide strikes. Is there a way to compare the deltas to use in picking the strikes? I'm not sure what you mean by that. If you're using spreads, then you're buying and selling options, and that's a different thing than a covered call and a protective put. If you want to follow up on that, John, happy to answer it, but I'm not sure what your question is there. What about a ticker that is wildly fluctuating like Tesla? Yes, that can be valuable. Just bear in mind that if it's wildly fluctuating, your option premium is going to be probably higher than a non-wildly fluctuating one. I don't know how liquid Tesla is, but my guess is now that it's become a pretty big cap stock, it's fairly liquid. So you could definitely use options to limit your risk on that, or generate additional income. But then bear in mind, if it skyrockets and has a melt up, then your covered call isn't really going to give you additional income. If there are no other questions,
but then if it skyrockets up,
yeah,
it may reach a plateau, and at which time then you could turn around and look at doing a cash secured put on that same stock and pick a relative out of the money range where the stock may pull back to, and you get assigned and you do the whole thing over again.
Yes. So if you're selling a covered call, range trading is your friend. That's for sure. If there's a range trade, that's your friend. If you're doing if you're selling a covered call and you're buying a put, that's really just insuring yourself against a big drop. So what you're basically doing is you're trying to protect yourself more than anything and reduce your risk. Again, these are all very active strategies. It's not a buy and hold type of situation. So I don't think it's suited for everyone. It's suited for someone who has the time to be looking at this.
Hey, Daniel, I got a question. This is Drew.
Sure.
Hey, buddy. Great job, by the way. Quick
Thanks.
question. Your personal philosophy on this more than anything else, are you buying and holding until the end of your expiry on most of your calls and puts for that matter? I was saying more calls, quote unquote. Or are you trying to get out so that theta doesn't catch up on the ones that you were already right on? You know what I mean? Like if you've already made your money, you're getting out.
Yeah, no, I understand what you're saying. So I don't do covered calls too much because you have to. It's just I probably should be doing, but it's just a lot of work. I do protective puts. So I do sell the covered call and buy the protective put if I'm sort of worried that there's going to be a market crash. It's a way of mitigating my risk. And I'll do it on a lot of the stocks I buy are in the Russell 2000. So I'm going to do it on the IWM, which is the ETF for the Russell 2000, which is just sort of macro. And so it's slightly different. But if you're just doing covered calls, what I would do if I were you is if you sell the covered call at a certain level, you probably want to put a buy price at something that you're interested in, especially if it's very long dated, because there's a chance that it gets to sort of maybe a very small price. So if your option was, for example, worth 1 cent, would you buy it back or not? You wouldn't just wait for it to go to zero at expiry. So if it was worth 1 cent, 2 cents, you might just buy it back because then you could always resell it if it goes back up again, right?
Right.
And given that it's a covered call, there's a price at which you probably are comfortable buying it back because you might want to sell it again at a higher level if it goes back up. So I would say you probably and you have to bear in mind what the transaction costs are of your broker. It really depends. If you're really if the option premium you're selling is like $2, so it would be a $200 option premium that you're getting, but your broker is going to charge you maybe $5 to transact that. You might want to just leave it to expiry because that's just a chunky component of the transaction cost. So you've got to bear in mind, you really have to think about transaction costs a lot when you're doing options because they tend to be more expensive.
Gotcha. Cool. Great job.
And you have to pay the transaction costs on both sides. Remember, right? You pay the fee to get in, and you pay the fee to get out. And if you basically let the option expire worthless, you don't pay the fee on getting out. That just expires worthless. So it's a way of minimizing the transaction cost by just letting it expire worthless. Any other questions? Otherwise, I'm going to call it an evening and wish you guys well with the beer.
Yeah, thank you very much. Thank you.
All right.
Good presentation.
Thank you,
Great
guys.
job.
Have a great evening.
Likewise. Bye-bye.
Thank you.
Take care.
Good presentation. Thank you.
Thank you, Jorge. Thank you, Phil. Thank you, Barry.